Understanding the craft of monetary policy. Money is the lifeblood of a nation's economy. Money serves several critical functions in an economy, like the way blood keeps the functioning of the human body. However, the economy is cyclic because it goes through periods of expansion and contraction, resulting in a recurring pattern known as the economic or business cycle. This cyclical nature of the economy is driven by various interconnected factors and phenomena, like consumer spending, business investment, government spending, international trade, and technological advancements. These factors don't remain constant. They fluctuate over time due to various reasons, such as changes in consumer confidence, shifts in global economic conditions, or innovations in technology. So, to maintain the health of the economy, the flow of money needs to be regulated with the expansion and contraction of the economy. For this, the Indian Central Bank, that is the RBI, adjusts interest rates to stimulate or cool down economic activity. Low interest rates encourage borrowing and spending, while higher rates discourage borrowing and slow down the economy. Now, to achieve it, the RBI deployed various financial tools such as reverse repo rate, open market operations, bank rate policy, discount rate, cash reserve ratio, that is CRR, statutory liquidity ratio, that is SLR. However, with the growing complexity of the economy and the dynamic global economic landscape, monetary management necessitated a fresh and adaptable approach. The approach demanded a monetary policy framework that is agile and responsive to rapidly evolving circumstances. It is in this context that India formally adopted the Flexible Inflation Targeting or FIT framework in 2016 in broad alignment with global trends. The underlying principle of this framework is that a clearly articulated, legislatively mandated numerical inflation target is the best foundation for overall macroeconomic stability. Low and stable inflation helps households and businesses in planning for long-term savings and investments, which ultimately drive innovation, productivity, and sustainable growth. On the contrary, high and volatile inflation corrodes the economy by denting productivity and the long-term growth potential. Well, inflation also imposes a disproportionate burden on the poor. As a UPSC CSE aspirant, it becomes imperative for you to grasp the workings of monetary policy in a dynamic and uncertain environment, as witnessed in recent years. So dear viewers, I'm Lipakshi Khurana from StudyIQ IAS, and you are about to embark on a journey of learning like no other. So sit back, grab a pen and paper, and get ready to be inspired. To understand it best, let's first take a look at how Indian monetary policy evolved post-independence. So during the 1950s and 1960s, as the country embarked on planned economic development, monetary policy assumed a developmental role, focusing on meeting the credit needs of the economy. This was done in accordance with the priorities identified under the 5-year plans. Bank nationalization in 1969 ushered in the era of social banking and led to the credit planning phase from 1969 to 1985. This period witnessed a widespread use of non-market instruments such as directed credit, administered interest rates, and moral suasion. In simple words, directed credit means allocating a portion of a country's financial resources to specific sectors or activities. Moral suasion means RBI using its moral persuasion to encourage banks to voluntarily follow specific monetary, credit, or lending practices deemed desirable for achieving economic objectives. Well, monetary policy during the 1970s and 1980s was constrained by fiscal dominance, automatic monetization of budget deficits, and excessive growth of monetary aggregates. The large-scale deficit financing and the resultant high monetary and credit expansion led to inflationary pressures. Now, these pressures were further exacerbated by a series of shocks, including the Indo-Pak War of 1971, the drought of 1973, and the collapse of the Bretton Woods system in 1973. Additionally, global oil price shocks in 1973 and 1979 further contributed to inflationary challenges. Now, these events precipitated the adoption of monetary targeting with feedback as a formal monetary policy framework in 1985. Money supply, or M3, became the immediate target with the objective of controlling inflation. In this framework, the Reserve Bank aimed at controlling the growth in money supply commensurate with expected real GDP growth and a tolerable level of inflation. The cash reserve ratio, or CRR, was employed as the primary instrument for monetary control. Both CRR and statutory liquidity ratio, or SLR, reached their peak levels by 1990. Now friends, this was primarily a result of continued fiscal dominance in the monetary policy framework. The deteriorating external balance position in the backdrop of adverse geopolitical developments and domestic macroeconomic imbalances in the 1980s had significant consequences. This situation led to a balance of payment crisis in 1991. In response to this crisis, India initiated large-scale structural reforms, which included the deregulation of the economy and financial sector liberalization. As part of these reforms, there was a shift towards a market-determined exchange rate system. In the wake of trade and financial sector reforms and the subsequent increase in foreign capital flows and financial innovations, the efficacy of broad money, or M3, as an intermediate target faced scrutiny. Well, friends, this examination occurred around the mid-1990s. At the same time, there was a notable shift towards market-based financing for both the government and the private sector. Now, in this environment, a multiple indicator, or MI, approach was adopted in April 1998 as the new framework of monetary policy. Under this approach, a host of indicators constituted the information set used for monetary policy formulation. Well, in 1997, restrictions on primary financing were implemented. Then, in 2003, the Fiscal Responsibility and Budget Management, or FRBM Act, was enacted. This introduction of fiscal discipline provided enhanced flexibility to monetary policy, increased market orientation of the domestic economy, and deregulation of interest rates introduced since the early 1990s also enabled a shift from direct to indirect instruments of monetary policy. The multiple indicator approach was in use from 1998 to 99 until a few years after the onset of the global financial crisis, that is the GFC, in 2008 and 2009. Well, this led to the introduction of flexible inflation targeting, or FIT, in India. So now let's look at the evolution of flexible inflation targeting, FIT. During the years following the global financial crisis in 2008, India witnessed a stubbornly high inflation, with retail inflation in double digits and growth losing momentum. Now, India's macroeconomic fundamentals like GDP, inflation, budget deficit, balance of trade, exchange rate, etc. appeared fragile, with widening twin deficits in both fiscal and current accounts and depleting forex reserves. India was identified as one of the fragile 5 economies. These events called for an evaluation of the multiple indicator approach. Accordingly, an expert committee was set up in the Reserve Bank to revise and strengthen the monetary policy framework. The committee recommended a shift to the flexible inflation targeting framework, which was formally institutionalized with the amendment of the RBI Act 1934 in May 2016. Well, the amended Act gives a clear mandate to the Reserve Bank to maintain price stability, keeping in mind the objective of growth. Price stability has been numerically defined as maintaining a headline CPI inflation target of 4.0% with a tolerance band of plus minus 2%. The tolerance band gives some room for maneuver to deal with things like economic growth, financial stability, sudden surprises in the economy, and mistakes in predictions. Well, the target is set by the Government of India in consultation with the Reserve Bank for a period of 5 years. Another major change with the amendment of the Act in 2016 was the shift from a governor-centric monetary policy decision-making process to collegial decision-making body in the form of the Monetary Policy Committee. MPC is entrusted with the responsibility of deciding the policy repo rate with the objective of achieving the inflation target, keeping in mind the objective of growth. The decisions of the MPC are taken by a majority of votes among the members present. In the event of a tie, the governor has a second or casting vote. After the conclusion of every MPC meeting, the RBI publishes the resolution adopted by the MPC. In addition, governor's statement and press briefings are the other modes of policy communication. The minutes of the individual members of the MPC are published on the 14th day after the meeting. While the RBI is required to publish a monetary policy report, the MPR, once every 6 months, which provides a more detailed review of domestic and global macroeconomic conditions. These provisions add to the transparency of the whole process. So now let's look at the forward-looking monetary policy and the importance of forecasting now. Because monetary policy has a time lag between the RBI's action and results, and uncertainty predicting important economic factors is crucial when making monetary policy decisions. It is for this reason that the inflation targeting framework is also known as inflation forecast targeting framework. So in other words, monetary policy has to be forward-looking. The forecasting process followed at the RBI has 3 broad components, which are nowcasting, short-term forecasting, and medium-term forecasting. So the first component of nowcasting looks at up-to-date information like economic indicators available before official data on inflation and growth is released. This is augmented with informed judgment based on extensive discussions with subject area experts, forward-looking surveys, and market intelligence. The second component comprises short-term forecast for up to 1 year. These come from models that use historical data and mathematical methods, analyzing both overall and detailed information along with survey data and early indicators that show what might happen in the future. While the third component involves generating medium-term forecast and alternate scenarios using the quarterly projection model, that is the QPM. This framework has been widely accepted and adopted by modern central banks operating under FIT regime. Its main purpose is to generate medium-term projections and policy analysis consistent with achieving the inflation target or mandate set under the FIT framework. Each of these 3 components has different forecasting horizons and hence different approaches. So these forecasts become the backbone of monetary policy making. However, the recent surge in global inflation and the earlier shocks from the pandemic and the Russia-Ukraine war have posed significant challenges to the monetary policy. So now let's take a look at how the RBI carried out the monetary policy maneuver. Inflation target. The RBI initially set a 4% inflation target. They reviewed it in 2021 and decided to keep it for the next 5 years. This target helped them balance economic growth and inflation control. Liquidity management. The RBI manages the amount of money circulating in the economy. During the pandemic, they increased liquidity to support the economy. When inflation went up due to the Ukraine conflict, they started reducing the liquidity. Supply shocks. Sudden events affecting supply can lead to inflation. The RBI monitors such situations and takes steps to keep inflation in check. Financial stability. Price stability and financial stability are connected. While some central banks faced issues due to low interest rates, the RBI maintained financial stability during the pandemic. Communication. The RBI has improved its communication to make its policies clearer and more understandable. In fact, managing expectations through effective communication is a vital instrument in the monetary policy toolkit now. So, in conclusion, we can say that the way India manages its monetary policy has evolved over time, aligning with changes in economic theory, country-specific practices, and shifts in the economy and financial markets. While the overarching goals remain the same, the focus on inflation, growth, and financial stability has shifted at different times in the various monetary policy eras since independence. Now, here are the key takeaways from the RBI approach to monetary policy, which the world has taken note of. First, Being proactive and nimble-footed during a crisis gives one the ability to respond speedily to fast-paced and overwhelming developments. Second, policy measures should be prudent, targeted, and calibrated to the need of the hour without being tied down by any existing dogma or orthodoxy. Third, monetary policy actions, when needed, should be backed up by appropriate regulatory and supervisory measures, including macroprudential instruments, to reinforce the policy impact and its credibility. Fourth, guidance and confidence need to be provided to the market and the wider public through effective communication as part of the endeavor to anchor expectations and sentiments appropriately. So, the study of monetary policy delves deep into the economic intricacies of an economy. It offers insights into the delicate balance central banks maintain between price stability, economic growth, and financial stability. This involves addressing numerous macroeconomic challenges and objectives. For this reason, an understanding of the working of monetary policy is essential for future policymakers. We hope you found this episode as captivating as we did in creating it for you. Until next time, stay curious and stay informed. And don't forget to like, subscribe, and follow. See you soon.